Piet Viljoen is the founder of R10bn and portfolio manager of the Merchant West Value Fund. He's also a canny observer of the corporate developments and has an obsession for capital allocation. And so a 13% plunge in Mr. Price's share price after the company has announced that it wants to spend 10 billion rand buying a German business. Rather, I suppose you could call it in the South African term, divorcification. It does not go with the Viljoen way of doing things, but we'll find out from him whether they might be able to pull something out the bag here. What is this obsession about South African companies just going where it has been a graveyard in the past? Even just this week, we had Spar having to take nearly a 5 billion rand write-off on its European adventure. I wonder how, heaven knows how much management time was taken. And then along comes Mr. Price, the best of the local capital allocators, and it wants to take 10 billion rand into a business in Germany.
Well, I'm not sure Mr. Price is the best of local. I think Lewis has done a much better job at allocating capital over time and generating good returns for shareholders over that period as well. So I think that's a very important point. There are retailers in South Africa that have actually allocated capital well. Unfortunately, most have not, and the hit rate is extremely low. The hit rate of South African retailers going offshore and making a success of whatever acquisition they make there. I mean, you can just run through them. Spar, you mentioned, famous brands. Woolworths in Australia, complete disaster. Truworths with its offshore activities. Steinhoff was a big acquirer of offshore retail assets. All of these failed miserably. And I was sitting here trying to think of one successful one. And maybe Pepkor. Maybe Pepkor was its Brazilian operation and its Polish, possibly Pepkor. But that's about it. I can't think of any others. So, I think the odds are heavily stacked against Mr. Price's management team in trying to create value out of this acquisition.
If you were sitting in their boardroom, what would the management have argued? What do you think they would have? How would they have argued, and how would you have responded if you were in that position?
I'm not sure what the argument could be. Maybe there's a good fit. Maybe they know the people. I'm not sure, because it's not only the acquisition itself, the fact that they're doing an offshore acquisition and the track record of South African retailers doing offshore acquisitions is so poor. There's two very other important aspects. It's not only South African retailers. Most offshore retail acquisitions by a local fail. Most of them fail. So if a UK retailer does an acquisition into Europe or into the US, it generally tends to fail. Retail is not something that crosses borders very easily. So that's the one aspect. And that's why, one sees a lot of failure in this regard. And number two is the price they're paying. Now, I can't make out from the announcement and from the presentation whether what looks like a 40p or very close to 40p is based on the right earnings number. But at first glance, it looks very expensive. Now they've also got the price against them as well. So not only is the strategy, in my opinion, probably going to fail, most likely, but they're also paying far too much for it. So
do you know
what
much
the story
about
in the boardroom, I have no idea what the story in the boardroom could have been. But I don't know. It makes no sense to me at all. None at all.
Do you know much about the company that they've bought?
Nothing. I've never heard of it.
Have you not seen it in your travels?
No, I'd never come across. I did know about David Jones, Woolworths' big acquisition in Australia. I did know that one, and that was a department store, which was again the odds were stacked against them there. But Europe has a lot of retailers. It's a very competitive retail market. So again, I'm not sure what Mr. Price management are going to bring to the party here to justify the price they're paying for this acquisition.
But they have got a high reputation here in South Africa, and they do say that it's a bit of a mini-me. It's a little bit like Mr. Price in South Africa, the German company that they are buying. That's the narrative anyway. Is there not maybe an exception here?
There is possibly an exception. I mean, I wouldn't rule it out. I don't think the chance of them succeeding is zero. I think they have at least a chance, but I think it's a very slim chance. And it's not something I would bet on as an investor. It's something as an investor, I would avoid it until I can see clear evidence of them succeeding.
So go back into the boardroom. Today, the announcement came out. The share price dropped 13%. That is a very strong vote of no confidence. What do you do as a director of this company now?
Well, basically what the market has done, it has knocked 8 billion rand off the market cap of this price, 8 to 10 billion rand, which is basically the value of the acquisition they're making. So the market is saying this thing has zero chance of succeeding. I think Mr. Price needs to come out with a very strong statement of why they will succeed and how they will succeed, which they failed to do in their presentation today, and why they're paying such a high price, which they also failed to do in the presentation today. So I think they need to do one of two things, in my opinion. Either they need to walk away, listen to the market and walk away, or they need to communicate better. One of those two things.
Have they done anything like this in the past?
Well, they've made a bunch of small acquisitions, but nothing like this that I'm aware of now.
It was interesting talking to the CEO of Spar, the new CEO of Spar, Angelo Swartz, this week. And I asked him, why did Spar go into Europe in the first place? And he said, well, they went into Ireland first, and that was very successful. And so they thought, well, this is easy. And opportunistically, they then went into Poland and Switzerland, which, of course, left them with a bloody nose. You look back on that and you think, oh, sometimes South African companies can be maybe a little overconfident in our own abilities.
Look, I mean, we do have some really fantastic business people in this country, make no mistake. But I think it's extremely hard to take your set of skills that you've built up in this country and your network that you've built up in this country and move it across borders to another regulatory environment, another legal environment, another social environment, a whole different environment. I think that's extremely difficult. And I think the hit rate of South African companies being able to do that is very low. And I think that is information that needs to be taken on board by anybody who wants to do an offshore acquisition.
This is where the unthinkable happened. They just came here and took his car.
No. I sold it to them. What's this?
It's crime scene tape. Did they pay you at least?
Within 15 minutes, money was in my account.
Were you happy with the number they brought you?
I got almost the same price of what I paid for the car. Everything was easy, everything was painless.
Well, there you have it, South Africa. With We Buy Cars, you won't come short. I'll tell you really.
1.93.
We Buy Cars, the easiest way to sell your car by far.
I just got to wonder about the management or the strategy of Mr. Price. Surely, I know it's you're probably breaking laws by going and saying to an investment analyst like yourself or a money manager like yourself, we're thinking of doing this acquisition. What would you say? But surely they should be testing the market before dropping 8 billion rand in market cap by something that really people don't like. Is it just impossible to do that?
Look, I think one has to be very careful, but they have advisors there that are in close contact with the market and that were advising them transaction. And surely those advisors would know what the mood of the market is and what the outcome has been for retailers in this case. And so I think one has to look at the advisors to see whether they gave good advice or not.
Yeah, but Piet, we've heard enough of Warren Buffett's talking and that the advisors are not there necessarily for anything other than putting money into their own pockets. And if they were to say, don't do it, it would be kind of self-destructive for their bonuses.
You'd probably not expect them not to say that because they would not earn the fees, because I know in this transaction, the advisor earning quite big fees. But I think the company should look to the advisors for advice on this in terms of what the market's reaction will be, how to communicate with the market, and all those sort of things. And I don't think Mr. Price have been well advised on this transaction.
Let's have a look at those two other companies that you mentioned. Spar, the fact that it's now exited from Switzerland and Poland, but carrying on in Ireland where it is profitable. Would you look at Spar now, given that it's been hammered, the share price has been hammered, and you're a value investor? Are you seeing 70 cents for each rand or something along those lines?
I think Spar is probably trading closer to where it should be trading. Remember, it not only lost a lot of money in its failed endeavors in Poland and Switzerland, it's also taken a lot of debt, and that debt is still sitting on the balance sheet. So I think one has to be very careful about investing into a company like Spar, which is still heavily indebted and is dealing with that hangover. So to the extent you can get comfortable with the level of debt and whether the existing business can service that debt satisfactorily and still have something left over the shareholders, I think that's the sort of thing you need to think about when you look at Spar.
And famous brands, that Gourmet Burger King, it's a much smaller company or much less market cap company than the other two that we've spoken about. And yet it dropped 2 billion rand on Gourmet Burger King in the UK. It just seemed to be a disaster from day one. Shame they weren't helped by the fact that COVID came along as well, which did not support that. But the fact that they've now stood up and decided to go into Malaysia, a very different deal though. Would you see any upside in what they're busy with?
Look, in principle, if you had to ask me as a business person, would I want to expand into Europe or would I want to expand into Asia? I'd choose Asia all day long. I would try and stay away from Europe and the US, highly competitive markets, politically not that stable, and all sorts of other geopolitical tensions in that area, whereas the East has a large population, probably, I'd hesitate to say less competitive, but I think there are gaps in the market there for people to exploit, just like there are gaps in the South African market for entrepreneurs to exploit. Generally businesses have stayed away from emerging markets because of all sorts of fears. So there is probably less competition there than in developed markets where most people feel more comfortable in competing. Therefore, there is more competition there. So I'm all for Asia. I don't know whether the strategy is the right one. Time will tell. I'm cautious on that sort of offshore expansion. It's very hard to do.
It sounds from the outside to be something that they know. They've dealt with the people at Petronas, who used to own R10bn here. They've put the Wimpies and the Steers into their service stations, and they seem to be doing something similar over there in the 800 service stations that they could put them into. So I guess from that perspective, they'll know very quickly whether the model is going to work or not.
And as long as they're not spending a lot of capital in it, then I think it is probably a sensible way to go about doing things.
Yeah, it's very capital light because it's a franchise. It's the master franchisee, and they won't.
So that makes strategic sense then.
The problem, though, I guess, is distraction of management's attention. And really, that's the question that we've been asking the guys at Easy Equities as well. They're banging this drum for the Philippines, but they haven't got that one right yet. And perhaps the guys at Famous Brands will also be a little distracted by what the potential is for Malaysia. But you got to. Nothing comes to you easily. You've got to put in the hard yards.
You've got to put in the hard yards, and you have to put in the human capital. It's not only the monetary capital that might or might not be affordable. It's also you have to add to your human capital to be able to do these transactions, because management does get spread thin, as you correctly point out. So you have to invest in your people. You have to expand your workforce and invest that way. So it does have a different set of risks to something where you are like Mr. Price is buying an existing business with an existing management team, but is using a lot of capital, monetary capital. Something that Famous Brands is doing probably needs less monetary capital, probably a lot more human capital, but you still need to invest behind it.
You are big on capital allocation. So when you look at transactions like this, is that the first lens that you look at it through?
Yeah. So for shareholders or investors, what the most important thing is the return on capital that the company you invest in is earning, and what you are paying to acquire that return. So you can have two companies, both of them earning a 15% return on invested capital, but the one is trading at 3 times book value or invested capital, one is trading at book value or invested capital. The second one is going to be a much better investor, because you will be earning 15% on your investment. Whereas in the first one, although the business is earning a 15% return on invested capital, you're paying 3 times book, you're only earning 5% on your invested capital. So one has to, look at those sort of things from an investor's point of view. But yeah, return on capital is the key aspect for any potential investment.
So Mr. Price is now taking a heck of a bet on an expensive asset. And I mentioned that in the introduction, the diversification. It's lekker, né? Wors. But diversifying offshore. I like my own jokes. But diversifying offshore, is that still something that you'd, given that you believe that South African stocks are offering great value, is that still something that you would advise people to be cautious on?
So from my point of view, I think the best strategy for an investor is to invest in companies that are doing well locally and that are staying with the local economy. I mentioned at the outset of the interview something like Lewis, where the share price has just about tripled over the past 5 years. Plus, it's paid a big dividend and has bought back a lot of shares purely by focusing on executing in the local market consistently on a simple business model, as opposed to companies like Truworth and Mr. Price, and those where the share price has actually now gone sideways for 10 to 15 years. It's gone nowhere. The strategy just doesn't make sense. Look, 10 years ago, these stocks like Mr. Price were valued at 30 and 35 PE, so it's no surprise they haven't done well since then because the valuations were very high. But I think for a South African investor, you focus on the guys who are doing well locally, and then you go offshore and you buy the best of breed offshore with your offshore allocation. We've had this discussion, you and I, Magnus. Any investor should be diversified globally. You should have some investments South African. You should have some investments globally. Don't look for the South African companies to diversify for you. Invest in local businesses and then take the rest of your money offshore and invest in the best offshore business you can find at the best valuations. I think that's a much more sensible strategy than backing local management teams to make those offshore acquisitions.
So in your book, Mr. Price is not going to get through that hurdle.
No, I wouldn't. I wouldn't touch it at this point.
What about talking on capital allocation? The announcement that came out this morning from HCI to say that they've been buying back their own shares very aggressively. They've now put 650 million rand into it, and they could put that much again into their own shares. Now I've got a vested interest here because you've just added it to the BizNews portfolios because it is deep value. And I listen to Mr. Viljoen often about this, go and buy something that's $1 for 60 cents and you're in front. What did you make of that strategy of theirs?
Look, let's take a step back. I think Johnny Copeland, the CEO of HCI, is probably one of the best capital allocators in the country. He has compounded the book value of HCI over 20 years at over 20% per annum, way in excess of anything the All-Share Index could have done. And today, you can buy that NAV, which is about 300 Rand a share, for 140 Rand a share, less than half, paying less than half price for that NAV, which is compounded at a very high rate. So for me, it makes perfect sense for the company to buy back shares. And this is something that Johnny has been doing consistently over the years. I mean, 10 years ago, they had 120 or 130 million shares in issue. Today, it's down to 90 million, and pretty soon it's going to be down to 80 million. So on a per share basis, they're adding tremendous value by buying back shares at these levels. And I think one can only congratulate them on fantastic capital allocation. Instead of, doing funny acquisitions in jurisdictions that they don't know about, they are buying back their own company for half price, which I think makes a tremendous amount of sense.
Unpack that for us, Piet. Why is it important that they have less shares in issue than more shares? Just for the novice investor who's probably not quite understanding why that's a good thing.
So when you buy a share of a company, you have that share's percentage ownership of the company's business. So if a company is doing 100 Rands worth of profit and it has 100 shares, each share represents 1 Rand of profit. But if it buys back half its shares, now it's still making 100 Rands worth of profit. The business is still the same, but it's bought back 50 of its shares. It only has 50 shares in issue, still making 100 Rands worth of profit. So each share now represents 2 Rands worth of profit. So you've doubled the profitability of your per share holding through the mechanism of the company buying back shares, and you haven't lifted a finger. You haven't done anything at all, but the value of what you own has doubled.
Now, Prosus has done this, Prosus Naspers. They've done this aggressively over an extended period. And, well, from what they were telling us, $45 billion in shareholder wealth was created. I'm not sure how you'd interpret that, but certainly from Johnny Copeland's perspective, the 650 million that he's put in there, how much value would he have created for shareholders?
Well, he's buying back shares at less than half NAV. So a rough approximation would be he's created double that value. So if he spent 700 million rand, 695 million rand, he's created 1.4 billion rands worth of value for shareholders.
Sure. And they haven't had to lift a finger, as you say.
And they all they need to do is just sit there. They didn't need to, like with a property, paint it or maintain it or chase up the tenant for rent. You just sit there and the management does it for you.
But I suppose the problem is when the management start buying back shares that are overvalued.
Like Anglo-American in 2006, 2007, 2008, they were buying back shares at massive valuations because at that time, commodity producing companies, resource companies were in fashion and management had lost touch with what was value and what wasn't value. But that is something investors have to judge for themselves, whether management is doing that or not, buying at a good price or not. But in HCI's case, I think it's pretty clear that they buying it back at quite a low valuation.
Piet, we've had some confusing information that came out this week, and I'd love to get your thoughts on it. On the one hand, we have the IMF, who came here in December. They left and they issued their report this week to say South Africa's got a few adults in the room, Treasury, the Reserve Bank, SARS, but it's got a heck of a lot of like naughty schoolboys who've been playing truant for a long time. And they're finally kind of understanding they got to study for the exams, but they're not likely to pass. In other words, our policies are the same old bad legislation when it comes to labor legislation, BEE, etc. All the stuff that we know. That's on the one side of the coin. On the other side of the coin, we're seeing that, well, the ANC doesn't want to change its ways. The document that was submitted to or passed on to its members ahead of this conference that they've had this week said the National Democratic Revolution must go ahead. We must double down on it, but we'll have these reforms. We don't agree with the economic reforms. In fact, the Government of National Unity is just a temporary situation for us. Once we've got back above 50%, we can dispense with all this nonsense. So as a South African, as an investor in South Africa, despite the cheapness of the shares, when you look at these signals that are coming through to us, does that worry you at all?
So politics is always worrying, but I have to make the comment, if you look back over the past 10 years, South African businesses have been able to forge ahead despite politics, not because of politics, but despite the politicians and politics. And I think what the ANC is saying here is bluster. I think it's a triumph of hope over practical outcome. And they won't get above 50%. All the surveys are showing their voting percentage is going down. But I guess they're talking their book and they're saying, oh, no, we'll change all this and do the revolution when we get back above 50%. It's easy to say because they're never going to get there. So I would discount a lot of what the ANC says. They talk a lot, but they do very little, and that's a good thing. The less the government does, the better. And you can see that I think they've done, over the past 12 months, they've done less bad things than the previous 24 and 36 months because they are not in power per se anymore. If you look at the fundamentals, you can tick them off. Our credit rating is due for an upgrade. I mean, we've come off the grey listing. Our bond yields are down 4 percentage points, 400 basis points. In other words, the cost of capital has declined tremendously in South Africa. It looks like we're set for some growth going forward. The actual fundamentals, apart from government bluster and stuff they talk about, which is nonsense in any case, the actual fundamentals are improving on a daily basis. And I think that is what we need to be cognizant of and not forget about.
Yeah, we're getting those green shoots. And I guess you also are seeing very slowly, but you're seeing some improvement from Transnet. And the Philippines company that's taken over and the Durban port should make a huge difference as well. Apparently,
that's a big sea change. That's a massive sea change. The government to bring in a private ownership into a state-owned company, it's a big change. So these things I've mentioned, and that one included in there, are actual tangible positive changes that are happening. While the government is talking about the National Democratic Revolution and 50%, all that, that's just bluster. The things that are happening on the ground are by and large very positive.
So ignore the bluster, have a look at the practicalities, like, for instance, the Eskom negotiations with Glencore, Merafe, and Samancor, where the conversation I had today with the group executive for distribution for Eskom was that this is a new template, that Eskom will now be talking to each industry to see how A, it can save jobs, by B, cutting the cost of electricity. In other words, ensuring that industries that had their backs against the wall could compete internationally as they did back in the day that they were created. Does that mean that it's worth reassessing some of these opportunities from an investor's perspective?
It was at the business conference in Manus, I think a year or 18 months ago, where the chairman of Eskom spoke. And he said the first thing I wanted to do was to stabilize the generating capacity of the country, power generating capacity. And the second thing that was on the agenda was to reduce the cost of power. And maybe we're getting to the point where they can start thinking about that. And these negotiations with Samancor and Merafe and Glencore, maybe that's a sign of that starting to creep in. Again, it will be a slow process. If it happens, I'm not sure it'll happen, but if it happens, it will be a slow process. But again, it will be trending in the right direction.
Yeah, you'd have to believe that government will take some responsibility for all the corruption that is labelled Eskom with all its debt and the very expensive Medupi and Kusile projects. But just to close off with, Outsurance, I had a wonderful experience with them this week. Personal experiences always tend to give you, you get jaundiced by them, but I was paying 1,623 Rand a month at Discovery Insure. I phoned Outsurance where they quoted me 709 Rand a month. That's under half. So look, from the one perspective, I should have been checking my insurance more often. But on the other, they're very competitive. And then I had a look at the way that the stock has performed. And that's really my question to you as a guy who really knows the financial sector. Is this the Capitec of insurance?
It seems to be in South Africa. It does seem to be, although the insurance market is quite competitive. Santam is another player there who has done very, very well over the past few years. I think if you take a step back and look at the insurance market, rates have been high for quite a long time. In other words, insurance companies have been paid very well for the risk that they've been underwriting. What normally happens when that insurance underwriting cycle has been hard, in other words, high premiums for a while, is it starts getting more competitive. They start undercutting each other, and maybe this Outsurance undercutting Discovery by half is a sign of that starting to happen, that they are reducing their pricing, in other words, taking on similar risks at a lower price, which over time leads to losses in insurance. And then, the cycle starts again. As soon as insurance companies experience some losses, then they start repricing, the pricing goes hard, and the positive cycle starts again. So insurance underwriting is quite a cyclical business. And right now, my reading of the matter is that these insurance companies are sitting on high premiums for the risk they're underwriting, very profitable, very high multiples. And I think as an investment, probably not that great.
Okay. Well, thank you for that. A good steer. As always, Piet Viljoen, the founder of R10bn and the portfolio manager of the Merchant West Value Unit Trust. As always, good to pick up with him. I'm Alec Hogg from biznews.com.